I got an email today with a report from Phil Anderson that was probably the best piece of writing I've ever got from the guy, and I wanted to share his thoughts based on that email and that report on his predictions for 2019 to 2021. Now, I've actually prepared for this video in a much deeper way than normal because there is just so much gold that's going to come out in this that I think will be extremely important, whether you're investing in shares, bonds, stocks, crypto, or property over the next 3 years. So buckle up, let's have a bit of fun, and let's take some of Phil's advice with a grain of salt. G'day guys, my name's Ben Everingham. I'm the director at Pumped On Property, and I'm also one of Phil Anderson and Fred Harrison's biggest fans. Now, I've read all of their stuff, I've watched all of their movies, I subscribe to their emails, I have read their books multiple times, got them completely littered with notes, and Phil wrote this incredible book called The Secret Life of Real Estate and Banking after reviewing over 240 years of American history based on the land market and the booms and busts associated with it, where Fred Harrison looked at 300 plus years of booms and busts in the UK market. Now, what I love about Phil is that he accurately predicted the 2007 financial crisis, and what I love about Fred Harrison is he accurately predicted the 1990s recession in 1983 and accurately predicted the 2007 global financial crisis in 2005. So these guys don't have a crystal ball, they cannot predict the future, but they have learned a lot from the past and have created some patterns based on that. Now, Phil Anderson effectively has an 18-year cycle which looks like this. So the last major decline was the GFC. Now, you have this period which you've just gone through of 6 to 7 years of upward price growth, and I don't think, unless you've been living under a rock, you would have to agree that we've gone through this incredible period of price growth, mainly Sydney, Melbourne, Hobart in Australia, but all of the big cities around the world. And we've also gone through incredible amounts of growth since the bottom of the last GFC in the stock markets as well. So we get to this point, which is effectively, I believe where we're at right now. Phil believes is where we're at now / coming over the next year and a half, and that is the mid-cycle slowdown point, where effectively based on the history we get a little bit of a decline sometimes in property prices, which we've already begun to see in Australia, and sometimes we can get a very severe decline in the values for a period of time in the stock markets around the world. And you might remember 2000, the dot-com bubble as the last time we went through this mid-cycle slowdown event. It mainly impacts the stock markets more than the property markets historically. In fact, in the US, sometimes it doesn't impact the property markets at all. Then we go through another 6 to 7 year period of time. We get to a frantic peak, and then assets and their prices decline again. Now, this is a period of time which effectively is a great opportunity to invest in assets, and the right assets, obviously not all assets. And then we get to a period of time just before the top here where all of the value of the cheap money from around the world has gone into those assets. All of the banks, all of the governments, all of the people in the countries around the world are, in a very leveraged position, and then credit starts to contract, because people are in short terms, most of the time, absolutely ridiculous with their money. Think about crypto, think about buying property in Sydney, in 2016 and 17. People buy for longer than they should. It creates a real bubble at the top. Then the bubble bursts and we get into another environment, which effectively takes about 4 years from there to get to the very bottom and to clear everything away. And then we get to the next cycle again. Now, whether you are a cycle person or you're not, and I'm not even sure if I am, this cycle of about 17.5 to 18 years has been running in America, and Australia has been following the American cycle for the last 200 years. The American one's been running for about 240 years. The only time this cycle hasn't worked, give or take a couple of years in this way, was during some of the major wars that we've had. So it's important to understand that there is this cycle in play, and you can go read the books The Secret Life of Real Estate and Banking, The Power in the Land, and really understand this stuff in a much deeper way. But some of the indicators to look for at this stage, as well as this stage, is a stock market top. Now, effectively, generally what we have happening in the stock markets around the world is that they go to a low in the global financial crisis, and then by the time we're in the mid-cycle slowdown point, most of the stock markets, or one of the indicators of markets around the world, is that stock markets above its previous all-time highs. Now, this obviously happened a while ago in America. It's happened in a lot of the other stock markets around the world, and the Australian market's getting very close to that point as well. We also get to a point in the mid-cycle point where we see a lot of tall buildings. Now, a lot of the tallest buildings in many of the cities around the world are being opened over the next couple of years. Because credit is really difficult to get in a GFC environment, but a lot of sites are bought at great prices. It takes a while for all of those tallest, biggest, bestest, most affluent whatevers to come to fruition, and they all seem to come in at about the same point. Now, we're seeing more tall buildings opening up around the world in the next couple of years than we've literally seen in the last 100, and you can jump online and have a look at that tall building indicator. We also get something at this point which we've just gone into in America, which is called the yield inversion. Now, effectively, for the last 60 years, this yield inversion has called effectively a recession in advance. Now, the yield curve might invert, and then it could take up to 2 years for the recession to come, but the yield curve has just inverted. Now, what we're talking about then is, in historically 10-year bonds, because you're putting your money away for 10 years, should have a better return than a bond that you put your money into for the next 3 months, for example, or 12 months, for example. Now, the reason you should get a better return over 10 years is because you're putting your money away and there's risk associated with a 10-year period that there's not as much associated in a 3-month period. But sometimes we have this yield inversion where right now the 3-month bond rate is actually higher than the 10-year bond rate, which historically, that little point, and it's well documented online and in Wall Street and inside the industry, has preempted recessions as they've come. Now, this time around, a lot of people know about this. A lot more people, the Financial Times, the New York Times, the Australian Financial Review, Bloomberg, all of these guys have been producing information on this for the last couple of years because there's better quality information available now. So history doesn't always perfectly repeat, but that's another sign or an indicator that you can keep an eye on, and one that is just tipped over. So we've now got to remember, according to Phil's report, that there is a difference between the US and the Australian markets. Now, one of the reasons why Phil thinks that Australia doesn't recover or doesn't do as well in terms of our stock markets and our property markets historically compared to the US in the first stage of the cycle is because Australia's economy is 61% dependent on services, where the American economy is a bit more diverse and actually has 17% of the economy attributed to manufacturing, and they actually make things over there and sell them to the rest of the world. So when you're delivering a service like I do, you make the money, but when you're delivering a product or a manufacturing product, you're actually employing people, but then you're selling something as well, which enables other people to be employed and more money to flow into an economy earlier. And that's why we can see that the American market has sprung back very well, where the Australian stock market possibly hasn't done as well, or at least that's what Phil's saying, and that might be very basic. There's so many other things going on, but this is just a report that I just got. Now, in the US, the mid-cycle slowdown point doesn't affect land values as much as the major correction at the top. Now, in the last GFC, certain parts of America, in terms of the land values, went down by 10%. In other parts of the country, land values went down as much as 50 to 80%. Now, in the last GFC, the stock markets around the world took an absolute beating, and some of the markets declined by as much as 50%, with some stocks declining by as much as 90%. So this, when we hit bottom, actually represents a once or twice in a lifetime buying opportunity. But the problem is most people are too scared to take advantage of that market at that time. Now, let's just play this over for a second before I talk about some of Phil's other notes. Let's say you knew about this in the last GFC in Australia. And so in 2007 to 2008 or 9, you really didn't do too much. Then from 2009, you started to invest in shares. Now, I'm not a financial advisor. This is not advice in any way, but this is just theoretically. If you had have started to invest in 2009 in stocks and held them until today, you effectively would have just about doubled your money in the Australian stock market over that time if you were buying at the true bottom and the right stocks of the Australian marketplace. If you had have also started to buy property in Sydney and Melbourne, because Sydney and Melbourne values, based on my research over the last 100 years, particularly the last 60 years, always do much better out of a GFC. So they do much better in this first part, and then they don't do as well in this second part, and markets like Brisbane and Perth do much better there. Let's say you had have bought assets in Sydney. You know, in 2011, you could have bought a 2-bedroom unit in Cronulla Beach or Bondi Beach for $400K. And then you had have done nothing but held that asset to now, 2017, you know, would have been the ideal time if you wanted to sell it to get out. But let's just say you didn't sell it at the top of the current cycle. You know, you would have almost doubled your money on those purchases as well. Like in most instances, in either Cronulla or Bondi on those 2-bedroom units, that would be worth between $650K and over $800,000 now. And all it would have taken would have been a knowledge of this cycle and buying at the bottom, and then either holding now because you've got a long-term strategy, or selling out a couple of years ago when I did, to get out of that marketplace because it was very, very clear it had topped out. Now, where we go from here, according to Phil's research, is into the second stage of the cycle. Maybe there'll be a bit more pain in the marketplace for the next 2 years. Maybe Australian property prices sit flat during that period. Some markets decline and some will increase in value. Maybe the stock market takes a bit of a beating around the world, different markets over the next few years. But then we get off to the second half of the cycle, and that's where places, like I said, Brisbane and Perth property-wise do well, or potentially where the Australian Stock Exchange, you know, might actually get some growth moving forward. So there's a lot more information on this online. Cannon Flack also published a really cool representation of this with different data points so that you know whether you should be buying or selling, whether you should be in cash or you should be in assets at different stages to help you understand it a lot better. Their financial plan is down there in Melbourne. But effectively why this happens is because at this stage there's almost no credit. And then what happens, as you've seen in Australia, we get lots of easy credit. The government artificially stimulates the economy. We put lots of money into infrastructure, construction, we make home loans easy to get. And then it gets a bit hot, which is the mid-cycle slowdown point. The government goes, oh shit. And so think about this from an Australian perspective. They started pumping money in 2010, 11, 12, 13, 14. They allowed the banks to go absolutely crazy. Then in 2014, they went, whoa, Sydney and Melbourne are getting a bit hot. We might have to slow some stuff down. And APRA came in and put the first speed bumps in. And then property prices continued to get hotter and hotter and hotter in Sydney and Melbourne until 2017. But the correction for what's happened now in Australia, which is a decline in property prices here, was artificially manufactured by the government so that effectively they could slow the prices down or even cause those prices to decline a little bit so that we could take a bit of the pressure off and it doesn't just create this ridiculous bubble down the line. Now, what happens here is we go through the mid-cycle slowdown point, which I believe we're in right now. Phil says that it's coming shortly and, you know, may further impact the Australian market, should, based on history, impact the stock market, but who knows? I'm not into stocks. And then what we get, and what we're already starting to see in Australia is, hey, we've gone through this sort of little slowdown in the property market. Let's start to drive easier and easier money into the economy. So we've got the Reserve Bank dropping rates at the moment. We've got APRA relaxing those things that they've put in place between 2014 and 2017. And we've got incentives coming in for the government, huge amounts of infrastructure coming on, huge amounts of first home buyers grants. So people think, oh, this is really bad, but it's nowhere near as bad as this type of event, the GFC or the big dip. and then they drive the prices of assets around, because I'll tell you what, if I'm only paying a 3% interest rate by the end of this year on my home loan, and the government's spending shitloads of money on infrastructure, and lots of investors are staying out of the market, you can guarantee that, you know, people like you and I that invest our money and save our money are sweet, but most people, when they start saving money, just start spending it, comes back into the Australian economy, into the property market, into the rental market, into the share market, into businesses. We get into this crazy frenzy at the top, and then we drop. Now, this game is based on easy credit, tightening credit, easy credit, oh shit, we've gone too far, tightening credit, easy credit, and that is the name of the game. So as an investor, you can flow, you can understand what's going on, you can step out of it when you need to, or you can move forward with confidence at the right time of the cycle. Now, I was just watching Warren Buffett's documentary on HBO, incredible doco, but one of the things that I loved is as he walks down his hall to his office, he's got all of the worst days in stock market history on his wall. There's about 7 days, and he reminds himself every day that anything can happen. Now, just because Phil has done some analysis of history doesn't mean that this is going to repeat, and he's always saying that. But based on following his stuff for the last 4 years, emails every single week, reports every single month, it is crazy and uncanny just how easy it has been. Now, 2 years ago, Phil started to tell all of us that follow his stuff to start getting into cash, to take advantage of depressed asset prices now, particularly in property in the right markets in Australia. I've been getting out, I got out of the Sydney and Central Coast markets and started investing in Brisbane and the Sunshine Coast. But he's been telling me that for years. He's been also accurately telling people about stock markets, which I don't do anything in, and he's telling people what's coming next. So in terms of now, some of the positive things in Australia is APRA is beginning to allow the banks, or very shortly will allow the banks to begin giving out money again. Now, the banks want profits, and those profits, you know, flow into the hands of shareholders, but they also flow into the Australian economy in terms of more people borrowing money at cheaper credit rates, and more of that money moving around, which translates into house price growth medium to long term. We've got a Liberal government, we've got massive amounts of first home buyers grants, we've got huge amounts of infrastructure spending about to start coming. You just watch over the next 2 years about the insane amount of infrastructure that starts coming up and popping up all around Australia, which is backed by the government. And the cool thing about the government being in surplus is that all of that money is now going to flow into artificially stimulating things again, like first home buyers grants, like infrastructure, like letting their hands go a little bit on the banks. And we've got credit growth, which hasn't started yet because there's a lot of people that are still scared. And you have every right to be scared. It's certainly not a time to go out rushing into the market. You've got to remember that just because Sydney and Melbourne have declined by 10 or 15%, doesn't mean that they haven't already gone up by 80%. So I'm not saying go into Sydney, Melbourne or Hobart that have all gone insane. It's look at other markets around Australia that haven't done as well. Get your head around the long-term history and decide if it's right for you. You know, some of the negative things in Phil's report is that he believes the mid-cycle slowdown is still ahead of us. He said that in Australia, the stock market's not at an all-time high yet, but you know, we don't know what's going to happen there. And another negative is that a lot of money is moving into these bonds, which is why the yield curve has begun to invert as well. And that's just not in Australia. Bonds, people have been rushing into bonds for the last 6 to 12 months all around the world, and that's been well documented. That's a leading indicator that, hey, we might just go for a safe option for a while rather than a risky option. Phil also has said that a lot of the markets around the world, stock market wise, have already reached their all-time highs, that a lot of these big buildings are coming out in the next few years, and he does believe that markets around the world should peak, you know, late this year, early next year. Now, whether that's true or happens or not, it's yet to be seen, but it'd be interesting to watch this video back in 12 months or 24 months time and see what's unfolded as a result of this. Now, what generally happens is we go through this period of correction, which we've been going through, I believe, in Australia for quite a period of time. And then all of a sudden positive sentiment based on easy money starts moving around the economy, and we get off to the second stage of the cycle, which is where people get a bit sillier, because the thing about this mid-cycle slowdown event is that property prices might decline a bit, shares might take a bit of a hit, but the economy generally gets through it okay. You know, we might be in a recession or a technical recession for a year or a year and a half. Some, you know, unemployment rates might go up, they might go down based on the government artificially pumping money. One thing I like about Australia is our government does start to, you know, do things a little bit earlier than most. It stepped into, you know, starting to put some pretty heavy measures in 3 years ago, 4 years ago now, to slow things down, rather than getting to this crazy point and then it really coming off the rails. Phil also goes in to finish the report by saying all of the preconditions, like stock markets around the world beating all-time highs, like property prices in the biggest cities around the world recording all-time highs, like a lot of the value of the easy money going into property prices in Sydney, Melbourne, the other big cities around the world, all of those things that set up for a mid-cycle slowdown or a recession are now in line. It's not the end of the cycle, and that's what you've got to remember, and that's the advantage that you have from watching this stuff or listening to Phil's stuff, because you know that this is mid-cycle, it's not end of cycle, end of world stuff type thing. You know, he goes on to say that he doesn't expect a huge crash in property prices, and in fact, in some places around the world, we might not even see a slowdown. Obviously, we've seen one in Australia in the last 2 years, but you know, he said you might not even see a correction in American property prices. Now, the biggest risk he sees to investors is people that don't understand where we are in terms of the bigger picture, longer term cycle, and that don't take advantage of these market conditions between here and here. Because if you're still freaking out about the last GFC and how much super money you lost or how much shares you lost, or if you're sitting on the fence right now and going, shit, I've just lost 15% in Sydney or 15% in Melbourne, a lot of people will sit on the sidelines between here and here, and that's completely cool. You know, if you don't know what you're doing or you don't understand the cycle, sometimes doing nothing is better than losing money, right? But what we will begin to see, not so much in the next year and a half, but after that, is money moving freely through the economy, asset prices in certain areas potentially beginning to rise, and then setting ourselves up for a nice big boom, probably the biggest boom of all time, followed by probably the biggest bust of all time. Now, Phil calls this, in terms of timing, this is 2026, this is 2019 to 2021 in terms of here, this mid-cycle slowdown point. This is 2021 through to 2024 in terms of this point before it goes absolutely crazy, and that is 2024 through to 2026. Now, if we look at this now, this is 2007, and then we go through to 2019. But you've got to remember that that was the very, very start of the GFC. And then the GFC really lasted until about 2011. So we've gone up from 2011 to 2019. Then we go through the mid-cycle point, which is 2019 to 2021. Then we go through the second phase of the cycle, where there can be great growth in the right markets or the right asset classes between 2021, 2024. And then we go through 2024 to 2026, where there's a lot of growth, but it's a dangerous time to be in the marketplace because you're paying a premium. And then according to Phil, 2026 is the top, 4 years to the bottom and the clean out after that. So whether this happens or not, this is what I love about YouTube. You can document it. Now I know there's so many people with economic backgrounds that have completely different ideas. The concept of the land taking all of the gains in society is what makes Phil believe that this will continue to happen, because as society increases, as people's jobs or incomes increase, as people make more money through their businesses, they effectively pay higher rents generally, or they buy more expensive properties, and all of that value of society ends back up in the land. And because most economists can't factor in land into the economic model. They don't even consider it. It's a completely separate thing. There's a huge oversight in modern economists and economic theory, according to Phil Anderson, that just makes a lot of people bypass this stuff. So the fact that you're hearing it, the fact that you're aware of this, you know, time will tell. This is Phil's prediction. I have no idea what's going to happen personally. This is Phil's stuff, but you know, it's been pretty cool to see what's unfolded so far. It was really cool to look at the history in his book, The Secret Life of Real Estate and Banking, and I'll continue to keep you updated. Obviously, this is almost like an online journal documenting his thoughts, and the cool thing is that over the next 15 years, we'll see what actually happens. So be safe. Remember that certain markets have done very, very well in the last 7 years. It might continue to be a turbulent time for the next 18 months, but that also represents a huge opportunity, because you really don't want to be buying here, which was like buying Sydney and Melbourne in 2016-17 and getting to a top and then getting a correction. What you really want to be doing is buying in the dip, buying the distressed shares when the market comes on sale, buying the houses in the marketplaces close to the cities that haven't done well yet, and really setting yourself up for a second strong half of the cycle. So I wish you all the best. Please be safe. Nothing in this video is financial advice. It is purely Phil Anderson's opinion based on the report that I got today, but it's really interesting and exciting to see where things go moving forward. So that's it in a nutshell. The next couple of years could be a bit turbulent. Also big buying opportunities, and off we go to the second stage of the cycle, or the races, as Phil says. So good luck. Thank you so much, Phil. I love you, mate. It was great to catch up with you when you're in Brisbane. Can't wait for you to come out and catch up again. And thank you for responding to all of my silly emails when I'm hitting you up asking you questions about the Australian market, when I know it's mainly the American market that you specialize on. But much love. Thank you so much for going and researching 250 years of history, and can't wait to continue to watch this unfold. Thank you so much for all of the money you've already helped me personally make, and hopefully other people in the future as well. Cheers, mate.